At the annual Jackson Hole Economic Policy Symposium held virtually last week, US Federal Reserve Chair Jerome Powell indicated that the central bank will soon start trimming its $120 billion worth of monthly asset purchases aimed to keep the wheels of the US economy turning. While employment figures are rising, Powell hinted that a rise in interest rates may still be off in the distance, as he cited near-term risks such as the spread of the Delta variant. Meanwhile, the Bank of Korea last week decided it was time to end a period of historically low interest rates, raising the benchmark rate from 0.5 to 0.75%. We discussed these developments and also what to expect in the months to come. For this, we're joined by Brian Chung, reporter at Yahoo Finance, covering the Federal Reserve, economics and banking. We also connect with Jinill Kim, Professor of Economics at Korea University, who served as a senior economist at the Federal Reserve. Thank you, both of you, for joining us today. And, well, to go straight into the discussion, let's start with you, Mr. Chung. Now, job figures and inflation numbers indicate that the US economy is very much recovering. But the surge of the Delta variant in recent weeks and the slowing pace of vaccinations in your country are causing some concern. Does the Jackson Hole meeting held last week indicate that these factors are going to remain as substantial risks in the weeks to come?
Well, based off of the commentary that we heard from the Fed chairman, again, that's Jerome Powell, it sounds like the Federal Reserve is certainly thinking about the downside risks of the Delta variant. Obviously, if there were to be some sort of large closures en masse like we had seen in the depths of 2020, that could certainly crater consumption activity again. But it seems like the political winds right now are such that the government is likely to not reimpose those types of shutdown measures, which is a big reason why, based off the commentary we've heard from Fed officials over the last 3 or 4 days, they've really said, as far as the economic data is concerned, there's not too much of an impact. And that's corroborated by the data that we've seen on inflation. As you suggested, CHEUNG, 4.2% was the pace of year-over-year increase in inflation as measured in personal consumption expenditures in July. When you take a look at the historical numbers over the last 30 years, we have not seen a print that high. So despite the spread of the Delta variant in the month of July, it seems like as far as consumption goes, it's really not all that impacted just yet.
Well, as you mentioned, Mr. Chung, inflation in your country, it's been off the charts this year, and many Federal Reserve officials, they've said that it will prove transitory. But the White House on Friday, they made an upward revision, didn't they, to their annual inflation forecast, and they doubled it from the 2.1% they forecast earlier in the year to 4.8% for the fourth quarter. What are the concerns that consumers have about price levels right now, and do you see the price level really simmering down anytime soon?
Well, this is a really interesting question because it brings into light the divergence between maybe what the economic data is seeing and what people at the store are seeing. And when you take a look at the headline inflation numbers, a lot of Fed officials that have said these types of price pressures are likely to be transitory, or that's their language, or temporary. They're really attributing that to abnormal increase in things like used car prices, which have gone up double digits in some cases month over month. That's because of semiconductor shortages, which Federal Reserve officials again reiterate is not necessarily related to easy money policies, part of these supply chain bottlenecks that have been a symptom of the coronavirus around the world. But of course, when you take a look at factors like savings increasing as a result of fiscal stimulus that the Trump and Biden administration put in place, there are some economists on the other side of the coin that say we should expect to see inflation a little bit more persistent, because that savings that's right now could continue through even the remainder of next year. A lot of Fed officials said inflation has come in hotter than we expected as of maybe 3 or 4 months ago. Also consider rising home prices, which could tick up the the cost of housing, which is also a big component of the price indexes as well. So there's kind of 2 arguments right now with regards to persistence or the temporary nature of inflation.
Well, there's been a lot of talk about when Fed is going to introduce interest rate hikes as well. And Professor Kim, Chair Jerome Powell said that the timing of the interest rate hikes aren't going to immediately follow the tapering of asset purchases, but then it would be articulated, as he said, by a different and more stringent test. What do you think the Fed means by this? What do you think they'll be assessing or evaluating?
So if I quote Powell exactly, he said a different and substantially more stringent test, because I don't know, Brian knows it better, but he prefers the word substantial a lot. So I'll get later. But so on the inflation front, as Brian said, there is huge increase in the last 12 months, which is probably transitory, hopefully. And on the inflation side, many Fed officials, whether they're hawkish or dovish, they all agree on that. So on that side, substantial progress or something further progress has already been made. But on the employment there, where the divergence of the views are still remaining. So Powell said in that speech that clear progress, more clear but not yet substantial progress, has been made on the employment front. But when it becomes substantial, then they start tapering. But the more stringent test on the rate hike would be the achieving the dual mandate. For example, on the inflation side, they will achieve or slightly above 2% based on average inflation targeting they adopted last year. They achieved moderately above 2% for some time. That's easier to achieve. But on the employment side, Powell and others want to see maximum employment before the rate hike. And what is maximum employment? There, a lot of divergent views are still remaining in the sense that how many more jobs do we need to have? Is the number of jobs before COVID, is it sufficient? But others like Governor Brenner are arguing that, oh, we should have more than that given the time difference. We have lost a year and a half, so we should have more jobs. So that when we talk about that more stringent test on the rate hike, a lot of debates on the maximum employment, the mandate would come up in the discussion.
And well, as for tapering, which will come first, the timeline to wind down those purchases, it's been a subject of great debate, not just in the US, but obviously all over the world. And well, when do you think would be the right time, Professor Kim?
So a lot would depend on the August employment report, which will come later this week. So as I chatted with Brian just minutes ago, in Brian's interview with Christopher Waller, Governor Waller said that he wants to see, if I remember correctly, like 850 new jobs in the report. Then he's ready to start tapering. So if that number would be achieved or higher number would be achieved, then they will at least announce tapering in the September meeting, and then they will start the tapering. But if the number of jobs created in August is not as satisfactory, then they may defer or procrastinate maybe a couple of months or maybe a meeting or two. It all depends on data. I think that's what the Fed had been talking about, the data-dependent monetary policy.
Right, so you're expecting to see maybe something more concrete in the September meeting. But, well, Mr. Cheung, what are you expecting to see from the meeting next month?
Well, as Professor Kim just acknowledged right there, it really all depends on what that employment report for the month of August is going to show. Thank you for plugging my interview with Governor Waller. Yeah, he did indeed say if it comes in at around 850,000 to 1 million payroll gains in the month of August, that would give him the green light to start announcing a taper in September. But here's the challenge. There are 18 members of the Federal Open Market Committee. This is the committee that ultimately decides the stance of policy. And there are a number of other people on the committee, as Professor Kim alluded to, that are on the other side of the argument. They would like to see multiple employment reports, which means even if August comes in strong, that wouldn't be enough for them. I'm thinking of, in addition to Lael Brainerd, Chicago Fed President Charles Evans, in addition to Minneapolis Fed President Neel Kashkari, who have both been on record as saying that one strong August report would not be enough. So that September meeting is going to be a toss-up. I've seen some Wall Street analysts, Fed watchers that have bet this is going to be the meeting where they ultimately do announce a tapering, a slowdown of that $100 billion a month pace of asset purchases. But then I've seen others that have said Powell's more dovish commentary and suggesting be careful about when you start to tighten might suggest something closer to November or even December. There are only 3 other policy meetings in September, November, and December for 2021. His speech did say it was likely to happen sometime this year. So I guess the question is, when do they announce it? Is it September, November, or December?
So is the September meeting still a bit of a toss-up, as you mentioned? And, well, Professor Kim, obviously markets around the world, central banks around the world, they've all been wondering when to start, when to end their policy of quantitative easing. And the Bank of Korea raised its key interest rates from 0.5% to 0.75% last week after 15 months of keeping it unchanged at a historically low base rate. And some thought the hikes would actually come later in October or November. So what do you think is the most important factor behind this increase that we saw this month in August?
So until the meeting, the market expectation was really a toss-up for the Bank of Korea meeting. I don't know whether it is such a 50-50 market expectation in Bank of Korea history, maybe not recently. And this time, I think in Korea, I mean, like in the US, the interest rates are at the historical low, and they have been doing this exceptionally expansionary policy for a year and a half. Therefore, they need to normalize at some time. And also, the economy has been recovering in the aggregate sense for a while. And inflation is also as high, not as high as in the United States, but as high as it has been. And most importantly, in Korea, financial imbalances in both asset market and especially the housing markets. That has been a problem, not only an economic problem, but also social and political problem. And those sides argue for the rate hikes. Of course, there was a Delta variant, and especially as the title or the theme of the Jackson Hole Symposium include the word uneven, the recovery is really uneven in Korea, especially the small business sector. They have been hit hard, and still they are under pressure based on this social distancing. So there are both sides, but Bank of Korea is going for more on the equity side of the economy, and they are more relying on the macroprudential or the financial policy for the unevenness at the moment. And that's why the Bank of Korea increased the rate last week. Mm-hmm. I think on the Bank of Korea side, it was not 50-50 even before the meeting. That's the sense I got after the meeting. However, at least the market was, as far as the market was concerned, it was a really toss-up until the meeting last week.
Well, Professor Kim, Bank of Korea Governor Mr. Lee Jae, he hinted that there are further rate increases on the horizon, and this, of course, coincides with stronger loan regulations. Well, when do you think these additional hikes will come, and do you think the policy will be successful in, really quenching the real estate market speculations and the soaring debt levels that we're seeing here in the country? So,
if I translate Governor Lee's words casually, he said he would not rush, but he would not procrastinate either. That's the word he used, I believe. And that is like in the US for tapering. In Korea, it's for the next rate hike. I think they are looking at on both sides of the economy. And in terms of timing, I mean, as Brian said, for the FOMC, the schedule for the Bank of Korea's monetary policy meeting has already been announced about a year ago. And then I don't remember all the Fed or the Bank of Korea data. They had many emergency meetings on the rate going down. Have they had any emergency meetings on the rate hike? I don't know, but much less likely. So there are only a certain number of meetings, and then the Bank of Korea is also kind of going through which meetings this year or next year they will do the rate hike. And then it's a toss-up, as in the case of the United States. And that's definitely the way the coronavirus has been treating us for the last year and a half.
Right, so wait and see seems to be the common policy everywhere. And Mr. Cheung, now the question is when the US is going to raise interest rates. And well, once it does, what's going to be the effect on bonds and equities? I mean, Mr. Powell, he upset the market back in 2018 when he introduced the 4 rate hikes. What do you think the impact will be this time around?
Well, so I think that might be a question that's better served after September 22nd, and that's because we won't necessarily get a fresh round of projections from the Federal Reserve with regards to where interest rate policy might be going until that meeting in about a month or so. Now, at least for the June meeting, which was the last time we got a set of these interest rate projections, the median member of this 8-member committee saw the possibility of 2 interest rate hikes, 2 25 basis hikes before the end of 2023. And even the more hawkish members of the Federal Reserve, like the likes of Patrick Harker from Philadelphia, who I spoke to earlier this week, they said they really don't see anything until the end of 2022 or early 2023 anyway. So the conversation about an interest rate hike really isn't likely to be a big conversation until the end part of next year. But for what it's worth, when it comes to higher interest rates, that was already a discussion that we had with regards to longer term interest rates, kind of where the market pushed up the 10-year bond. We saw that rip up to as high as 175 basis points in the spring. But interestingly, it came back down. There's a lot of argument for why U.S. government bond markets have had so much interest. People who were trying to short U.S. government long-dated debt really had a rough time over the summer. And a lot of people are arguing maybe that could be because of inflows abroad. There's a lot of concern about the delta spread, especially in emerging and developing countries. That's a big reason why maybe fund managers there are trying to buy U.S. government debt because they want U.S. dollar-denominated debt, despite the fact that interest rate differentials might actually be favorable with the likes of the Bank of Korea or Bank of Brazil is another one that I'm thinking of that have been a bit more hawkish in raising interest rates. It seems like at least for right now, U.S. dollar and U.S. dollar denominated assets still appear to be favorable.
Well, due to time, this is where we'll have to leave the interview today, but that was Brian Chung, reporter at Yahoo Finance, and Jinill Kim, Professor of Economics at Korea University. Thank you both so much for your time today.
Thank you.
Thanks.
And to our viewers, as always, thank you very much for watching.